This is a full and complete breakdown on how the BRRRR method works as a real estate investor, so this way you can understand it as a beginner. Today's video is brought to you by Connected Investors, but more on them later. In this video, we'll cover what is the BRRRR strategy, why would you want to use the BRRRR strategy, why would you not want to use the BRRRR strategy. The BRRRR strategy is an acronym that stands for buy, rehab, rent, refinance, repeat. You first buy a house that's cheap and discounted because it needs some work done to it. Then you fix it up yourself or get a contractor. Once the work is done, you rent it out to start making some monthly income, and then you refinance the property to pay off your first loan and get a second, longer-term loan. That loan will hopefully give you the initial money you put into it. Then you can use that to repeat and get another property. Let's go one by one on each step, go more in depth so you can understand it better. First step. Buy. Your objective is to find a property that will be cheaper for you to get than if you were to get it normally. When I started out, I was really confused what this meant because it didn't really make any sense. Isn't the price on the property like the price on the property? How do I get it for cheaper? Well, in real estate, everything is actually super negotiable. Meaning, just because someone wants or thinks their house is worth $100,000, it's not. It's only worth what other people are willing to buy it for. Once I got a house for $56,000, that was actually worth $170,000. That's a huge difference. You can't really do that with the stock market or crypto. Now, most houses you won't be able to get for a discount because they're on the market. So most times you'll need to find properties that are off market for this situation. Off market properties are ones that aren't on Zillow, Realtor, Trulia, or any of these other sites. They are called this because they're not on the market actively to be sold. But just because they haven't put their home on the market doesn't mean that the seller doesn't want to sell their house. But how do you find these off market properties if they aren't on Zillow? There's other websites for that, and one of them is known as Connected Investors. Connected Investors is one of those sites where you can get a free trial with the link in my description, which allows you to find information about any house in the United States. This way you can actually see if they're interested in selling their house off market or not. Your objective is to use a site like Connected Investors to contact the owners of properties that might be motivated to sell their house. And then you get in contact with them to make deals. Now, the truth is, most of those houses are not on the market because they aren't interested in selling. That's where seller motivation comes in. Seller motivation is simply the reason why the seller wants to sell their house. There are two main reasons why a seller might want to sell their house. Either they themselves are in some form of trouble financially, or the house is in some form of trouble and it might cost them a lot of money. Here are some examples of them being in trouble financially. Maybe they just got a divorce and they need to sell their house quickly. The owner of the house died and the kids have it and they don't want to keep it, they're just trying to get rid of it quick. The owner's about to go into foreclosure because he can't pay his bills, and so he'd rather sell the house before he gets foreclosed on, which will hurt his financial situation long term. Examples of the house being in some form of trouble are the house is a rental property and it's vacant and it's costing the owner lots of money and they're not capable of getting another tenant. The house is in terrible condition and it needs to be rehabbed. There was a big storm that came by and destroyed everyone's roof, and the owner doesn't have enough money to pay for the new roof, so they want to sell their house now. This sounds like a lot of information that you would have no clue on how to get, but luckily for you, Connected Investors has it. They have a bunch of different ways to tell if the houses or if owners are motivated to sell their house. So once you find one of these houses, you add them to a list of owners that you are going to have to find the contact information for, and then you contact them. And once you get them on the phone, you see if they're interested in selling. Since those people are more motivated to sell their house, you have a higher likelihood that they'll actually sell it to you and sell it to you for a discount. Now, but just because you're getting a house for a discounted price doesn't necessarily mean it's going to be a good deal, especially a good deal for a BRRRR. Here's the information you'll need to understand if it's a good deal or not. You need to know how much it will cost you to fix up the property, what the property can sell for, what the property can rent for, and what it will cost you monthly when you're renting it out. To find out how much it will cost you to fix it up, here are a few methods. If you know a contractor, you can ask a contractor to walk through the property and give you an estimate to complete the project. You're looking for an itemized list of all the items that need to be fixed up and a price. Ideally, you want to take multiple contractors through to the property, so this way you can get them to estimate the cost to fix up and the materials together and compare them side by side to see which one's going to be the best price for the best job. And if you need a really quick estimate, Connected Investors on their site actually has a feature that comes up with the rehab level for the property based on a few different factors. Now, I always recommend you get a contractor or multiple contractors because that will be more accurate, but a quick method can help if you're trying to analyze the deal quick. To find out what the property can sell for, you need to find properties with similar number of bedrooms, bathrooms, square footage that's sold recently. Now, Connected Investors actually has a feature for this called Comp Report, which it will show you all the properties nearby that meet certain requirements, so you can see how much it's worth by looking at those comps. Now, to figure out how much the property can rent for, look at Rentometer and look at the rent prices for properties in nearby. To figure out what your monthly costs will be, you need to calculate your mortgage, your property taxes, insurance, property management, and savings, and how much all of that will cost you. I have a whole video on that, breaking all that down, so we can't go into all that here. Now that you have all this information, here's what you're looking for. First, the price you buy the property at needs to be about 75% of what it's worth once it's fixed up, minus the cost of rehab, minus the cost to hold the property, and minus the closing costs on the first loan and the second loan you're going to get. This allows the property to be worth enough when sold to get all of your money back and paid off. Second, once it's refinanced, you need to make sure that the rent covers all the costs and makes you a profit. And so the formula for that equals rent minus all the expenses. This is why the BRRRR strategy is pretty hard to do. There's a lot of criteria involved in finding a good BRRRR. And if you find a property that meets these criteria, it's important that you make an offer right away. Now, before you move on to the rehab stage here, let's quickly touch on how you'll actually buy this property. Because these houses are usually in bad shape, normally you can't buy them with normal bank loans. You typically need a hard money loan, a private loan, or cash. Now, if you don't have cash, then that will strike you out, obviously, for that. And if you don't have the right connections, finding a private lender might be hard. This is why most people go with hard money loans. This is what I use. They're high interest short-term loans that are meant for fixing up a property and either refinancing or selling quick to pay it off. And they even cover the funds for the rehab. The best part about this is that Connected Investors actually has a whole private lender marketplace where you can find and meet these hard money lenders. So now that you buy the property, it's time to do the rehab. And if you're like me and you don't know how to fix anything up, you're gonna wanna hire this stuff out to someone else. The most important thing about this is that you manage the work as it's getting done. So here's a few tips. Make sure to have a budget and an estimate and stick to it as much as possible. Reviewing each transaction that the contractor is asking for. Ask the contractor for pictures and videos of the work that's getting done. Try and get a property manager or the real estate agent that you use in the transaction to stop by a couple times to take a look at what's going on in the project. Follow up with the contractor often, especially if you haven't heard from them for a couple days. As you're getting work done, if you run out of cash to pay for funds of the rehab, that's when you do what is known as a draw request. This is one of the huge pros of using a hard money loan. You send an inspector out to the property, they took a look at what you said got done, and if everything got done, they'll refund you the money that you had, so you replenish your cash to spend on the next part of the rehab. Okay, so let's say your rehab finishes now. It's time to move immediately to step 3, which is to get a property manager to help you rent this place out. You want to find tenants that have good jobs, pass background checks, and don't have any evictions on their record. Please make sure to pay attention to state laws to really understand how you can vet tenants in your state, because it's different state by state. So let's say you got the property and it's cash flowing. Great, but the problem is you're stuck with the high interest rate hard money loan and you need to get out of it, especially because in a year it'll balloon and you'll have to owe the whole thing, which how are you going to get the money for that? The only way to do that is either sell the property or do what's known as a refinance. So you're going to refinance it into a 30-year loan. Now you can do this in a few ways. You can first use a conventional investment property refinance loan or a DSCR loan. If you have a full-time job or full-time income from a business and a good debt to income ratio, then you should go with the first option. If you don't have that option, you should go with the second option. That's what I get as a business owner, DSCR loan. It allows you to get a loan based on the rental income of the property, whereas the first one gets you a loan based on your income. A lot of the hard money lenders will also offer DSCR loans. Here's how it works. Most lenders will give you up to 75% of what the house is worth now that's fixed up. So if you have a $100,000 property, they'll give you a $75,000 loan. So that $75,000 goes back to pay off the hard money loan and pay your pocket back for the money you used on the down payment. This allows you to get more money, the initial money for the down payment, to then do the last step, which is repeat. Now you can repeat the process finding another deal like this. The time frame for this will be somewhere between 3 months to 1 year, depending on seasoning periods, how long it will take to rehab, how long it will take you to find tenants and get approved for loans. So let's break down some of the pros and cons. The biggest pro of the BRRRR strategy is that it is the most scalable strategy out of all real estate investing strategies. The biggest problem with getting more properties is usually having the money for the down payment after you spend it all on a rental. This allows you to get the money back in a quicker time frame, allowing you to reuse it over and over again, and increasing equity in property, fixing them up, and increasing rents to the highest amount. The second pro is that you'll have fixed up houses that you'll be able to charge max rent and have built-in equity in all these properties, which will help build your net worth over time and help decrease vacancy and increase the amount of money you make. And the third pro is that you're actually doing this with a lot lower money down. Hard money loans sometimes allow you to go as low as 7.5% down, which is a lot cheaper than putting 20-25% down on an investment property, which you typically have to do. But this all depends on how much money you have, the experience you have, the deal you find, your credit, and all that. A few people should not be doing this strategy. It's kind of really hard to find properties like this. It takes work and it takes time. And last is it's complex. For beginners, it becomes a little bit more complicated because you're combining two different strategies, two different formulas, and you're learning a lot about how that all works. And so if you're starting to get overwhelmed, I'd recommend you pick one of the two strategies, either fix and flip or rentals, instead of trying to do both at the same time. And once you learn about one, then you can add the second layer, which is learning learning how to do a BRRRR. Check out Connected Investors if you want to learn more about how to find off-market deals or find hard money lenders through their private lender marketplace. And I'll catch you all later. Have a great day.